Hi guys, welcome back to another lecture. I believe we've made it now to lecture 12, which is just phenomenal. We've come a long way, but here we are. And today we're going to cover another lecture, and I've got so much exciting stuff to show you about market profile. I guarantee that you are going to really find value in this lecture today. So stick around. If you haven't seen the previous lectures, you should go back and watch them starting from lesson 1. If you're not doing that, you're depriving yourself of a very good learning opportunity. It's a chance for you to come at this from a professional point of view and do it to the best of your ability. I know for a lot of people, trading might be a muse. It might be something that they don't take seriously, but if you're here and you're looking to take trading seriously, then that's where you want to start. Most people would wish they started to trade with market profile. It will save the anxiety, it will save the mistakes, it will save all the misconceptions about what a market can and can't do. It will just really put reality in your face. And I think a lot of traders, they absolutely need that. They need a huge reality check. So I'm hoping that this lecture is going to be part of that process, but also if you haven't done the previous lectures, please go back and do them. This is lesson 12. You're going to be a little bit lost, and I probably won't go back to the beginning to talk about everything that we talked about before. So please do that. It's hugely important. It will just be a benefit for you. Okay, moving on to more exciting things. So we have today, I'm going to take you through configuring the profile so you can use it on short-term frames. A lot of people don't even know that they can segment profiles into 1 hour profiles, 4 hour profiles. It doesn't have to be a daily profile. It doesn't have to be a weekly profile. Because when you think about it, what does a profile do? Essentially, a profile takes the market and organizes it like a bell curve. So what essentially you're seeing is the price distribution over a given period of time, which allows you to see essentially where traders are concentrated in their ideas or where they're concentrated on orders, and it gives you a sense of the repeatability of the market itself, right? And this is massive because now you can start using those key points of reference or those key reference areas to start to plan trades, right? And it's that simplicity that market profile brings that no other way of visualizing the market can give you, right? I don't care what it is, you're not going to have the same level of depth as market profile. Now, bearing in mind, I've been in this game for a very long time, and I've worked with traders who've used different ways to trade and have traded different assets. So I've worked with traders who trade stocks. It almost seems impossible if you're a small caps trader to be able to trade if you don't understand how to read level 2, or typically would refer to it as the dome, right? If you can't read depth of market or level 2, or the tape, time and sales, you're going to struggle as a small caps trader, right? And those things are very numbers oriented. So people who are very good with numbers are going to be able to work well with the dome. But if you're not very good with numbers and you like to visualize patterns, then often you're going to find yourself drawn to charts as opposed to the dome. If you try and combine both, then often you get confused, right? You don't know your brain can't tell you what to prioritize. So it makes trading small caps very difficult. So you get a few people who really excel at it, and then they make a ton of money and everyone else feels guilty because they can't do it. And then you've got the traders who are focused on just trading candlesticks, naked price action, and so on. But then the problem comes for those traders is, where do I get in? What's my key reference point? Because what you want is to be able to create something that's repeatable, right? You need to have a point of entry that you get in every single time, right? So every single time you get these repeated events, right? In the business, we call it reps. So you get all these reps that you can take advantage of when they occur. Now, 90%, and don't take offense, for some of you might have already discovered what your repeatable event is, right? But most people don't have that, and they're pretty much lost. You don't have to go far. Any major forum today would have traders asking questions, where do I get in, where do I get out? I mean, I've been seeing these questions for the good part of 17 years. It's the same thing. It's like people never learn, or it's for somehow doing all these courses hasn't really helped. But I can appreciate the fact that finding a repeatable event can be much harder than it looks, especially if you're using a candlestick. If I gave someone a candlestick chart and said to them, show me something that happens all the time on this candlestick, that happens at least 50% of the time, show me that thing and then trade that event. Most people can't do that. And then you've got traders who come in with indicators, right? And they say, well, if the indicator, especially oscillators, right? So things like RSI. So they say, well, if the indicator is at an extreme low, then I'm going to buy. But the problem with that is that often those indicators, because of their nature, they work well when the market is in a range, because then you've got a repeatable range. But this is not the case for some markets, like the S&P 500. That market doesn't range. It might range in a smaller frame for a little bit, but for the most part, it's going to be extending. So if it goes on a bit of a tear, where you as a trader should be making money, what tends to happen is the indicator keeps telling you to sell. Or if it's going in a downward direction, it keeps telling you to buy. So as a result, a lot of people lose money because they simply can't replicate that repeatability because the market had changed direction. So what I'm saying is that you need something that doesn't work around any of those kind of frames. You need something that works around the dynamic nature of the market, the fact that the market changes, the fact that it could start to trend today, it could start to range tomorrow. You need what I like to say are solid reference points, right? And that's why we do market profile. So me having this conversation with you now is just bring you a degree of awareness that if you stumbled upon this channel, then you're incredibly lucky. I'm not a well-publicized YouTube channel. I don't have the wow factor that a lot of the influencers have with their channels, right? As you can see, it's pretty boring. So it really only appeals to people who learn and who want to learn. And the way the YouTube algorithm works is that, well, if you're running a channel that has a lot of hype and a lot of people are kind of drawn to it, well, that channel's going to get pushed a lot more. If you're running a channel that has a lot of information that requires people to engage a lot more, then what tends to happen with those channels is they don't get pushed a lot because they're not drawing people in instantly. Instead, they're asking people engage with the information because it's going to be beneficial to you. So all the good channels that could potentially help you, they're not popular. Most people don't even know what they are, who's behind them, right? So it's just like this channel. It's just not going to be popular. I like to think I'm a good and I'm a great trader, but on the same token, I'm not this huge personality, right? I don't have this huge Twitter account. I run a podcast. I've spoken to some of the world's best 7-figure, 8-figure traders. In fact, I've had 2 market wizards on my podcast, but I'm an unknown person in the trading space. Other people might know me, but outside of that, I'm not in the retail community in that way. So, I'm not popular on, the places where retail traders go to get their information. So if you find me, it's because you've been doing a lot of deep digging. And that's what the YouTube algorithm does. If you do a lot of deep digging, especially around the market profile, there's not enough content there, I would normally get suggested as an option. I'm going to get suggested around traders who are not talking about market profile, who are popular, but they're talking about maybe volume profile or something related. They're going to get pushed first regardless. So the chances that you stumble upon my channel are actually really small. But I don't mind because I'm not going to change what I say or what I do in order just to get views, right? I'd rather just do my trading and make my living that way than have to make my living on YouTube and tell you guys what's not true, right? And I hope people still listening who've managed to stay this 10 minutes, right? This is going to be a very good lecture coming up, but if you've stayed for the 10 minutes and you've heard what I've said, I'm hoping you can appreciate that I'm only about giving you value, and I'm hoping that's the reason you're here, is you're looking for a change. Potentially you want to trade for a living. I trade for a living. I don't do anything else. So for me, this is serious business. Again, I'm aware. Some people just want to find out about the market. They want to wet their feet. They never think about quitting their day job. They might love their day job. I don't know. The bottom line is that if you don't and you want to become a full-time trader, then you need to be sticking with this channel. You need to be watching every single lesson. All right, moving on. A couple of things we spoke about from the last lecture, right? So we talked about the NASDAQ, right? And I think I was saying to you that we were going to at least revisit the highs, right, where we initially saw that liquidity high fall, right? Again, if you're new to the channel and you don't know what I mean, just watch the other lectures. It will fall into place. I'm not going to go over that, but we know that there were buy stops sitting here and we were trading lower and we were drawing on that liquidity, so we said we were going to go much higher, right? We had all the other reference points. We knew there was a bid stack at the low, right? We can see that here. We also knew, despite having an offer stack, if we split this profile here, right, let's split this one, and then we split finally this one, we could clearly see that right here there was a liquidity low and we expected a draw on that, and as soon as we started to revisit this range, that meant that we were going to go higher. And my initial target was, we're going to trade up to this high, which is that 260 point range, right? And that's where we're probably going to start to see the market back up, right? So that would have been our initial goal, and we did achieve that, and now we're going a little bit higher. But also, what did I say? I said that once we get above that level, we should now start looking for, because that's a major high, we're going to start looking for buy stops to get run, and then we're going to potentially look now for a revisit or at least a dip back into bid stack. So this is a daily profile. So our focus on this profile is, are we going to set up in such a way that will indicate we'll revisit a bid stack? So I believe that's coming, because now effectively we drew on liquidity initially. We didn't go far enough. We got supported by this bid stack, and then now we're rebuilding and we're breaking into new highs. So the new liquidity level becomes the high here. So we're just above that. So any breakdowns or any strong price action revisiting the range is going to open us up to a correction potentially over the next coming days. Right, so that's crucial. I'm judging by the behavior we're just seeing. Now we haven't opened the NASDAQ yet, right? So this is all pre-market activity. There was the US inflation report today, so that's had an effect on the market at a pre-market level. So when we open the regular trading hours at 2:30, which is about half an hour, then we can expect to start seeing some serious movement, right? And that will give us a clue as to what's happening next. So again, if we split this profile, what we're witnessing here is pretty much near equal highs, right? We've seen an attempted draw, a pullback, a move up, but we haven't seen this level visited, neither have we seen this level visited. So we haven't really traded back into this bid stack. So from my point of view, I would like to see us come back into that level, and I would like to see us essentially keep going higher, and then that would give me the indication that, okay, we're essentially having a bit of a breakout, we're going to cool off at some point and we'll come back down. But from where we are now, if we start to revisit this level, it'll be a good chance that we're going to trade back to the J period low down here. So that's the prior day low. So that's the general expectation, but the NASDAQ hasn't opened yet, so that's pretty much all hypothetical. But it allows us to set up for a plan, right? It allows us to set up based on other key reference points, right? So that's looking at the NASDAQ. The other asset we spoke about was corn, right? And I did tell you guys in the previous lecture that I'm going to come back and I'm going to revisit corn because this was crucial, right? And then we're going to jump on and I'm going to talk to you guys a little bit about how we can organize this into shorter frames if we wanted to trade those time frames, right? Because we can still use the profile and it's amazing what you can see. This is a daily profile of corn, right? So we can see over several days, we've seen heavy draws on liquidity. And when we're dealing with assets like commodities, now all assets behave differently. And if I don't touch on that this lecture, I'll touch on it in the next lecture, is how do we choose that asset that we want to trade based on behavior, right? So how do we know how to trade each asset? Whilst most assets are similar in the way they distribute price, they have different volatility, and also the participants in those markets approach them in different ways. The agricultural commodities I really like because they deliver price in a very clean way that you don't even see with the S&P or some of the other assets. So let's take a look at corn. Corn was on a downtrend. And I'm going to take a 5-day look back just so we're clear on this, right? So I'm going to split the profile at this point so we can see where the low was. And then I'm going to split this profile, so I'm going to really start from this window. Right, so Z period is 330. Let's have a look. NASDAQ open 230, so that's when the commodity markets open with the NASDAQ, so that's 230. So that's the first, so that's X period. That's the first move that we get when the market opens. That's X period, where we can say that. So if we take this profile, for example, this was the pre-market open, right? So this was essentially 0300. There's a 2-hour shift, so we're looking at versus London, it's 0100 London, right? So the market opens, we trade lower in the pre-market, we put in a low, and then we start to rally in the same pre-market. If we look at how far the pre-market is extended, it's extended pretty far, right? So typically what we'd be expected to do is we look at, there's an offer stack right up here. So we know that this is going to be a difficult level for the market to get over. So we rally on the pre-market, and then we open regular trading and we do a dip. Now, if we're going to trade this, we need to see us go back, right? And this is important. We need to go back to the pre-market low, and that becomes an opportunity. But what does this market do instead? It dips out of the pre-market, rallies back up again, and then takes the liquidity at the pre-market high and closes lower. Typically, if you've seen this kind of movement, you can opt to go for an end of day short, because that's 3:30, so we're half an hour into the Chicago session, and because these markets open and close, essentially we're going to close regular trading pretty soon, and that happens at 7 p.m. right? So that would be 7 p.m. London, and then we're going to rotate into the next day. So if we're taking a trade at 3, we don't have a lot of time in this trade. So if you're going short, what that would look like is we close down on Z, you're assuming the liquidity is gone. It's the pre-market high. We go short. In a strong seller's market, we should go down to the pre-market low. It's a very clean price delivery. Instead, we open, we tick above. If we get short here, we want, this is approximately 1 1/4 point stop. But we're trying to aim for at least maybe a 1.5 point stop to clear the highs, or a 2 point stop, right? Which I tend to like. But whatever you choose, you're going to look to trade and see if we can get back down to the low of the open, right? So that takes us to about 3.5 points, and then we pause and we close roughly about 2.5, 2.75 points. That's okay. That's not bad. Technically speaking, it will be just over a 1-to-1, but you didn't have much wiggle room. The market's going to close, so you can take your profits and leave. This day wasn't appetizing for someone who was trading regular trading hours, because again, I wouldn't be buying the market to go long at the fair price. Instead, I'll be looking to trade this because I've seen a draw on the liquidity to the downside. But we didn't go far enough. So if we collapse this profile, we've got a bigger picture. So this is the whole day. Now, if we look at this whole day in reference to this day, what we've just witnessed is a draw on stops on the daily low, which tells me that based on where we closed, which is within the daily range from the prior day, we should get an update back into the fair price from the prior day, right? So back into value. We know there's an offer stack there, so we're not going to push it. So having seen that, we open the next day, and this is the pre-market low. So we open, we trade much higher, and then we can see 1630, slight shift now, we can see the Z period open, right? So that takes us all the way into the offer stack, and then we beat back lower. Now, what have we seen on the open? We've seen the market open, go a little higher, take out the liquidity above the pre-market high, and then close lower. So on the rally, I want to get short. This is about a 2-point stop, and I'm looking to take this to the pre-market low. So we dip a little, we do about 4 points, right? That's a 1 to 2 already. You could choose to exit at that point, or you could choose to keep holding for the pre-market low, which we eventually got for about 5 3/4 points, right? Nearly 6 points. There was a bit of a rotation back up, which is why we wouldn't really do that whole break-even management. I don't like that on commodities because we can move up on them quite quickly and then continue lower. So if you've covered here and then we rallied back up, you can sell again to go back down. Otherwise, just hold the trade for the full 6 points. So that's a bit of a layer of money management that I just introduced there, but that's how we would do it, right? So again, we can see that really simple concept, right? So we've worked primarily on the visualization of the liquidity. Now there are other things that you can see. You can see that the market had bids that stacked up down here and we closed higher. So there's definitely a strong buying level. You can see a lot of the distribution was at the center, but we have a bulge, so that's a bid stack as well. When we opened the pre-market, the first thing we started to do was move higher, right? So by end period, if you're still trading the pre-market, then you can get long with stops under the pre-market low, which is roughly about 2 points. So let's say an end period, and then you can trade this for the high of the prior day, right? Which was the Z period high. In fact, we broke further into the stack, which will be a good place to clear your trade. That should give you also a pretty good risk reward as well. So again, there's a lot to take from this, right? So once we traded that stack and retreated out, we can see that Z period had a responsive seller. We can tell because of the single print. You can see that single print here. It wasn't traded again. So prices there were so competitive that the price never really went back there within the intraday. Instead, we closed below the opening price. So clearly there was a strong reaction to the rallying call. So where's the market going to go next, the next day? Well, I'm sure we can all start to deduce that the next key level of interest, seeing that we've had such a strong seller response, has to be the low of the day before, right? So now we're in this day, we've seen this day, this is the low of that prior day. So that's where the market is going to target, because we've already seen a strong seller, we've seen it about to go lower, and we know that there are going to be stops from the daily lows down here. What does the market do? It trades down to that level, right? And we can interpret that story. Again, we opened a pre-market, we've already closed here, and then we start to go against the shorts. But that's just the market searching for more sellers at more efficient prices, which will tend to be the upper parts of value high, right? Because value high is the highest, fairest price. So most traders are going to want the highest, fairest price. They're not going to want to trade so much from the mid of value, right? They're going to want to be at the extremes of value. So that's where we know the market's at the very least going to go. So we've now hit the mode price, or the fairest price within value, right? And that's denoted by the point of control. And we've already done that in the pre-market, and we're going up in the pre-market. And then we open, A period open, 230. You can see this is the regular market open. Now there would have been very little time for you to process a short, even if you had a short bias. Now we can clearly see at X period in the pre-market, there was a draw on this high here, which would have brought in a lot of stops. And we can tell because on Y period we went down, and in Z period we didn't really come back to retest the high. And then we opened the market, traded to the X period high, and then fell off. Right, so clearly there were a lot of stops here. On the drive down, we're thinking if we can trade the J period low and recover, then we're going to take a long position. That happened here. On the pullback, you just want to be able to squeeze in 2 points, right? So that would mean that you'd be looking for an entry, which would be about here, that gives you close enough to 2 points. This is about 2.25. It's not quite 2 points. And then we have a breakaway. The strong reaction in B period would have told you that we hit the bid stack here and we also drew on the liquidity, so we're going to get a pretty big move. So you'd want to jump on that. And where's the market likely to go? Well, at least to the high of the day, right, which is regularly trading hours, or the high of this prior day, which was also regular trading. And if we collapse this profile, we can see based on the setup that we've had a strong reaction, responsive buyer to match now responsive seller. The responsive buyer is more recent, so we're assuming that the responsive seller won't hold, but we also know there's a stack, so it's going to be tough. And then we have bids forming here, market closing lower. So there are a lot of people offside here, and we're going to need to shake them out. Let's go to the next day. You can see that the market opens, rallies a little bit to that value high, pulls back, and now we're heading into regular trading hours, right? So we can see that Y period open, right? And if you notice, the openings are shifting because of the way we're printing the TPOs. So just ignore that and just take the opening within the period that it's happening, right? Which in this case, Y period was 2:30, and that's the open. Again, we pull back, we can see that, we come lower, and then the market opens and does a big tear to the upside. Now, if you look very closely, we've got the Y period low, which is where we drew all the activity from, rallied in Z period, and that tells us immediately we're going to get some continuation. Unfortunately, this was such a strong move that there wouldn't have been much room for you to jump in and have some fun. So instead, you might have wanted to sit this one out, or you'd want to establish a short, essentially that you're willing to hold overnight with stops above the Z period high. That's a bit more of a riskier play. I prefer to wait for the market to open. We open the next day, there was a clear move to the upside. And so if we collapse this profile, right? So that was the higher day. We moved above the higher day, drew on liquidity and closed lower in M period. Now, if you saw that, that's a classic shorting opportunity in the pre-market. And that would have been London, 8:30. Go short, 2 point stop. You're looking to go all the way down to the low of the regular trading hours at the very least. That is an 8-point run. I'll take that. It's worth it for the risk. Executing in the pre-market through regular trading was worth it. In fact, by the time the market opened, Z period open, it was already a 7-point run. And look again, if we collapse this profile, so the sellers have answers, they closed the market underneath the lows. Again, we're anticipating another stop run against the daily lows. So we're setting up here for a huge move in corn that we probably is going to end up being a multi-day runner. So if we're a longer term trader and we saw this stop run, so we have an open, lots of bids, huge close, and we can see how that played out. We traded pre-market low. In fact, I saw this trade in Y period, and that was a long for me. We won a 2-point, because again, you can see that we set the pre-market low, but most importantly, we rallied above the lows established at the open, and we also rallied above the lows established in the pre-market. So you can see that XY by Y period, we were well within the range of the open. What's that telling you? It's immediately telling you that if we're already here, then we're likely to do continuation. And where is the next relevant high? Well, that's all the way up here. So this is going to be a multi-day runner because we're probably not going to achieve that all in one day. So if we get into this, we can say, well, 2-point stop, I'm going to trade this at least to the T period little dink here where there might be some liquidity. But based on the way these assets deliver, you should really be looking for the high. So this was a classic opportunity to turn an intraday trade into a long-term position that you could hold. And now you can see we're about to open the market. This is the pre-market. We've had a pre-market run. This is the high. We're now settling into the offer stack. So let's see what the market does at the open and see if we come to draw the liquidity up here. And if we do and close lower, then you'd go short for the pre-market low, right? Which should be where we'd establish. Now, the way we've set up, because we're expecting a multi-day run, for example, it could mean that we're going to not go down to the pre-market low. It may well be that we might hold the T period, sweep some stops here, and then continue and break out to this level here, or potentially fill the gap, right? So because we're in this bullish mindset, doesn't mean that we're going to ignore what the market's telling us, because again, we could revisit those highs. In fact, we're more likely as well to clear the Z period high. Right. Oh, whoops, hold on. There we go. We're more likely to clear the Z period high, and then we're more likely even to retest value high. Right, so we're expecting a pretty big extension even into the open. So we could open and then get a big run before collapsing. But we have to wait for the reaction. You see, we have to see it. So we can deduce it in terms of planning, but we have to see it, because this offer stack is getting weaker and weaker. And I'm getting the sense that the market is going to try and attract sellers at these prices. So a lot of this trading malark is about good planning, right? It's just about having the time and the discipline to sit down and visualize the market in the way I'm teaching you to do it, right? And if you're doing it this way, you're going to be coming into high probability setups. Now, all these examples I've shown, whilst a lot of it has been on the left side of the chart, I have come to the right side of the chart and given you a plan setup if you were going to trade corn coming into the open in about 7 minutes. Right, so you'd have half an hour to see the open. You'd be then into the next half an hour to decide what you want to do. You've got a whole hour to decide what you want to do with this asset. Point in case. Okay, so that's a discussion there with corn. Let's pivot a little bit from all of this stuff, and let's talk about the short term. So I'm going to pop over the euro dollar. Right, so today we've had the inflation report, so everything's a little bit distorted. Now I've zoomed out a little bit on this TPO, so please bear with me, guys. If you're on a mobile, you won't be able to see it. So just, again, I would advise you can zoom in on your mobile screen, so just open it up so you can see clearly with each point I'm going to show you, or just go to a computer and watch the video there. Honestly, I know people love their phones, but I don't understand why people still use phones to watch YouTube if it's not an entertaining YouTube. I think you should be using a computer, especially if it's a learning experience, or television, in my opinion, at the very least. But if you're using a mobile, then you're doing yourself a disservice to watch these things. So I'll definitely advise use a computer, because you get the full depth of it. So you could use a profile. So this is and setting this up is pretty easy, right? So let's say, for example, I pop on this 1 hour profile, and this is what it's going to look like. All right, so again, I've got 50 profiles because that's what I want to say. Unfortunately, I can't see more than that. Data doesn't allow for it. So I've got a 3-day look back on these short-term profiles. This is a 1 hour profile, 5-minute rotations. It's a start time of midnight. So essentially 10 o'clock in London, but midnight in Europe. It's a 1 pip row size and a 1 rotation balance, right? So pretty easy to set up, and this is what you want to go for. You can drop this to 1 minute if you definitely want to get a more tighter feel, but I'm happy with 5 minutes because, again, we're trading the profile here as opposed to the rotations in this scenario. But again, we can always observe the rotations. So what I'm hoping that what you've been picking up through the lectures is that whenever we see a bulge in the profile, that represents a consolidation on a sort of linear candlestick chart, right? So when we look at a horizontal profile, when we see that bulge or that P shape or that B shape or that neutral distribution or that normal distribution in the middle, that's what we're seeing. We're seeing a consolidation collapse. And we all know that consolidation essentially means that the market has found agreement in fair price. And very soon that they will fall into disagreement, essentially imbalance, right? And then everything is going to go nuts. We already know that. That's common territory. Now, what the profile tells us is how thick that area is, and we can see a reaction of price against that. So we're on the left side of the chart. We're going to come to the right side of the chart soon. Been a lot of information, a lot of data. Right, so starting initially with the left side of the chart. So we can see initially that we opened, we went higher, we started to show some consolidation. Normally, if we've seen the market go down and we formed this kind of U shape, right? So we've gone down, showed a bulge in the profile, consolidated, closed up, essentially means we're probably going to go higher for the next couple of hours. And what are we going to look for? We're going to eventually create a significant high, and we're going to look to draw stops against that high. So as soon as we start to consolidate, we can tell that people who are long here have started to exit their trades. Right? So we're now forming these highs. So these are all trade exits. And then we put in finally a high, and then we start to go lower, and we form a block, an hourly block of price distribution or profiles that are going lower. We slightly consolidate in the early morning sessions, and then we move to draw on the stops here. Now we know that because we can see one, a responsive seller, 2-print E period, very steep close, a trade above a significant high from the market close on the prior day. Let me collapse this so we can see. That was the 9th of June. This was 1 o'clock in the morning on the 10th of June, right? So that's an Asia session where we draw and close. Now there are two ways you can approach this. Now that we've seen that, we can assume that we've drawn on the liquidity, we're back in the range. So within the 5 minute, we set up an A period balance, and we can say as soon as we break the balance low, we're going to start to position to trade short. So we can see that we open A period, we go up, we fail on the 5 minute window, and then we close lower or punch lower prices in C period. So now we can get short on any small rotation back in, and then we can look to put stops above the high, that's about 12 pips, or just above the high of the rotation, whatever works for you. I like to be a little bit high on my stops, so we can also go for a little bit above value high, right? But we want the strongest place for stops. And then look how we shoot lower. So that's already a 2-to-1. That's 36 pips. And what are we aiming for? Well, we can see that there's a significant low price here. So we expect this market, as soon as we start to trade into this level, we're going to start to see stronger reactions. So if we collapse this profile, we can tell that there was a huge amount of sell orders here. The thinness of the profile, we can see that there was a draw on liquidity, and we knew that traders were already exiting their positions here. So now we're going to go lower, and we expect that at some point we're going to draw on the lows. So again, I'm going to bring in, we've talked a lot about liquidity, I'm going to bring in the time side of my trifecta, which is when do I get in the trade? Naturally, this was an Asia open, so it was a relevant time to trade. It's a major center open, right? Mid 100 in Asia. So we're looking at obviously markets like the Nikkei and all of these guys coming into effect. We also know that 10 p.m. London, that's when the Forex market tends to kick off. That's the Forex market open, which is midnight in Europe. So it's relevant enough if you were an Asian trader. If you're not an Asian trader, you probably don't want to be taking trades at 0500 in the morning, 0600 in the morning, which is about 3 a.m. in London to 4 a.m. in London. These are not times you want to be trading, right? Because that's sort of about lunchtime in Asia, and very similar to lunchtime in New York. That's not a great time to be in the market. You're probably, whatever direction you're taking, it's probably not going to hold. Now, if we fast forward to 8 a.m. in London, that's the London Open, much more relevant session for euro dollar. So we can see in London, we push lower and we draw on the stops under the low, going back to 2 p.m., which would have been the NASDAQ session the prior day. And then we draw against that low at 8 a.m. London, and we close higher. Now, what's that immediately telling you, right? So we got all this thin tail distribution, and then we close out. If we split that, you can see that we had this big run in B, quick rally back up again, and then we consolidated. That's immediately telling you that you need to be long on the next hour. We're probably going to get a pretty big run. So at that point, the moment we opened the next hour, I want to go long, have my stops here, which is about 9.9 pips, 10 pips, or I want to get my stops under the low, which is about 20 pips, right? But that will extend us into the entire day's run, right? So we're going to probably hold this for quite some time. 10 pips, in my opinion, is good enough. We know that's a significant value low. And the one thing we can observe with all these rotations is that the lows find it very difficult in an upward direction to get under value low. Value low is a significant resistant point for most markets anyway. So if we're trading close to value low, that's what's happening. We're getting close to value low and then resetting. So we're either going to take it out or we're going to continue. It's really difficult to punch under value low. So if the market opens in this case, fair price, then I want to get long. What's the repeatable event? The repeatable event is the draw on liquidity, the draw on liquidity. Now, if I do just these repeatable events, then there's a good chance that I'm going to be profitable and we're going to see some more. So this is the first repeatable event. This is the second repeatable event. And both of these would have left you in a profit. So that's already a 100% win rate on 2 trades. And this is over 2 days. So notice across the day, I've had 2 opportunities. So this was on the 10th of June and this was on the 10th of June. And then if we look at the opportunity that's about to come up, we only had 2 in the course of the day, but it's likely we would have only taken 1. We were not going to take all 2 because, again, you'd have to be on some kind of drug to be able to stay up from that time in the morning to that time in the morning and then keep going for it. That's just madness, right? You're going to sleep or you're either going to be the Asian trader or you're going to be the London trader. You're probably not going to be both. Now let's look at what happened the next day. So the next day we moved in. So we traded, and this is the 10th of June at the NASDAQ open, 2 p.m. So we get to the US open and then 2 p.m. we consolidate. What's that telling you? We're seeing a bulge in a profile at the high, which is an offer stack. As soon as we start trading under that, then the market has established a short bias, right? So that's what we're looking for. So again, if we look at the high of the day, high of the prior session, put it up there, right, you can see that we pushed above that, drew, and likely we're running buy stops. And this bulge is telling you that's what's happening. And then we start to break down back into this zone. Immediately, what do I want to do? So if I split this profile, and I can see we've gone up here and we've had a rush downwards. We're back into the trading range here. Immediately, as soon as we can rally back up to this line, right, I'm going to establish a short, that's 10 pips, and I'm going to look to take this lower. Well, 10 pips, 20 pips, 2 to 1. We pull back a little bit, we struggle around here, and then we push 28 pips at the low. Right, so it's almost a 3 to 1 at this stage. Now you've got a choice. Now you're into the 11th of June. You can choose to cover the trade at the start of London, which would have been your best opportunity because you'd likely be asleep in Asia. If you set your take profit for 30 pips, then you would have achieved that in London. It was a bit of a seesaw because it was after hours, but eventually we went down there. What happens in London, right? And this plays into today. So now we're into the right side of the chart. Delete this, and so it doesn't matter the asset you're looking at, right? So this was the low established, right? So we come down in the London open, we run some stops, close higher, and then we got a bid stack. Now all that's telling you is that when we open at this point, we've got a choice. We can wait for a dip back into the bid stack, or we can get long, stops under the low, that's 15 pips, into a major session running into an inflation report. If you're right, it means that, let's say you traded the open, right? You've seen the repeatable event, 15 pips on the London open, You're looking for 30 pips out of 2 to 1. That puts you here. And that means that you're going to be in this trade up until the US Open. Because you've got a 15 pip stop and you're thinking you can get at least 30 pips on this asset on one run, that's a 2 to 1. So if you're looking to get 45 pips, it's possible. It's an inflation report. If the market rallies, you're going to be able to achieve that and probably a little bit more. So you can also decide, well, that's the position I'm going to take, is I'm going to get in and try and run it for 45 pips of 3 to 1, and then I'm going to break even a trade just in case I get some volatility in the information report. Entirely up to you. Either way, your risk is only 15 pips, right? And again, it's a repeatable event. So we've seen that again. If we were trading Asia, what did we notice in Asia? Again, we had a draw on the stops here. We can tell from the close down, if we split it, we went up, came down. In fact, we had an internal draw, which was up here at a high of the open of that bar. But if we've already broken lower, I can get short on a pullback with stops above the high. I want at least 8 pips to be fair. 6 is just pushing it. So if I'm at 8 pips, then I'm looking to push 27 at this point, right? This is where we are. 3/8 is 24, so we're more than a 3 to 1 at this point. That's good enough for me, right? So if you're an Asian trader and you saw this move, that's your reaction. Let's say you were even debating. We had a draw here as well on the shorter time frame, and we pulled back and then we went back up. Then again, you can get short and make it even tighter, right? Again, it will be about 8 pips. That's a 29 pip run, right? So it doesn't matter. As long as you're executing around this area, you're fine. Again, if you look at how close it was to the offer stack, oops, delete this for a second. Put that horizontal line. That's pretty damn close. Look at that. It's almost picture perfect, right? So the offer stack was good enough protection. Point in case. We saw a small reaction in Europe at that offer stack and we closed back. And again, you could be forgiven for saying that I'm going to get short as opposed to long. That's perfectly okay. Because again, for you to deduce we're going higher, you'd need to check a profile on a higher time frame. That's it. And that might have given you that little perspective you needed to know that this level wasn't going to hold. But whatever your decision was, if you were long, based on the time element of things, you won't be taking a trade at 12 noon, because that essentially would be about 10 o'clock in London. 10, 11 o'clock, 12 o'clock, avoid trading those times. You're not going to get much movement. So me as a professional wouldn't be short, right? You as a retail trader, as you're learning, you're probably going to say, well, I saw a draw on liquidity, so I'm going to go short. Well, that's where the trap is, because yes, there was a slight draw, but it didn't go far enough before everyone got taken out on a G period move. Those are those inexperienced traders being caught out by this huge move that we can see in G period, which was the inflation number. Now we've gone up, pushed a responsive seller. The likely impact to this is we've set a new high. There are going to be stops above there. If we break this down, there's a high likelihood at this point that we're going to start to pull back for the rest of the day, because now the inflation numbers come in. What we're looking for, if we want to trade short, we need to see us come back within the trading range of this block here, and then we're going to start to see opportunities for us to go back to the lows. It's really simple, and we can easily do that from looking at a longer time chart. This is a big expanded move. We don't have to look at it on a shorter time frame. We can look at it on a longer time frame. Really simple. It's not complicated. It's just essentially making sure you're trading at the right time, you're trading in a repeatable event. Now, I hope this lecture has been useful when it comes to short-term stuff. And I wanted to cover this because it's not something that you see on profile. So even if you do run into someone else doing market profile, which I doubt you would, but if you did, and they did a TPO chart, it's unlikely you will see them segmenting it to do things like this to their advantage. This is an advantageous view of the market. I'm getting volume, time, and liquidity all in one window, and I'm also able to visualize this against a longer term profile. The edge you are developing here is enormous, right? It's enormous. And you cannot have something like this and say, well, I'm going to just keep trading candlestick charts, because it's not easier to trade a candlestick chart. It's just the first thing that got put in front of you. Anyway, guys, hope you enjoyed the lecture. I'm going to leave it here until my next lecture, guys. Adios.